Hey, I'm Josh Mahony, Chief Market Analyst at Scope Markets. Let's look ahead to the RBA interest rate decision on the 18th of June. That certainly should be an interesting one. Of course, we've come off the back of the FOMC decision. They kept rates steady as expected, but now pointing towards a single rate cut for this year, according to the latest dot plot that follows on from the interest rate cuts from the Bank of Canada and the ECB. So we've got the more dovish side of things with the ECB and Bank of Canada cutting rates alongside the SMB. We've also got the prospect of the Bank of England cutting rates in a few months' time in September. And then we've got markets expecting a single rate cut from the Federal Reserve. Well, how do things lay up for the RBA? Well, markets are currently expecting nothing from the RBA this year. And there have been big question marks about whether they're more likely to raise rates than they are to cut interest rates. And that's a good thing, because ultimately what you need within the FX markets are two differentials to trade against each other. For instance, the likes of the Bank of Japan keeping interest rates in negative territory at the same time that we've seen significant rate hikes elsewhere around the world. That provided the basis for Japanese yen weakness and strength for many of the other currencies, the likes of the euro and the US dollar, against it. And so the Australian economy and the Australian interest rate outlook really does provide the basis of potentially a strong currency to be trading against others if they're cutting interest rates. So that's the backdrop with which we go into this meeting. We want to understand whether things have changed. Are they more dovish, or are we sticking along that line where we're not going to see anything this year and we're going to potentially see another rate hike? Let's get into the data. I'll show you a bunch of economic charts, and then we'll go into the outlook for a couple of the FX pairs and the Australian stock market, the ASX 200. So first and foremost, here's how things lay up in terms of the interest rates from a sort of comparative sense. This is particularly interesting because, as you'll see, I think I should go full screen on this one to give you greater clarity. As you can see here, the RBA is in the blue. So yes, we've got the ECB at the bottom here, but the RBA already has interest rates significantly lower than its neighbours in New Zealand, significantly lower than the likes of the Federal Reserve, the Bank of Canada, the Bank of England. So from that perspective, the likeliness of them cutting interest rates swiftly is lessened. There's not as much pressure on them to act because they, as they said a long time ago, the RBA essentially said, we don't need to raise rates to the same degree because the rate hikes in the US will do the majority of the heavy lifting for us. And so they're already coming from a relatively low base. It's not actually low, but it is lower in comparison to its peers. This is an interesting chart. Again, probably more interesting to see this in full screen. You don't need me. So this is an interesting chart showing you the breakdown in terms of the share of fixed rate mortgages and therefore the amount of people that will be impacted more swiftly by the hiking of interest rates. Notably, if you're looking at Australia, they're right up at the top. So much more sensitive to movements within interest rates when it comes to mortgages, because many people just have tracker mortgages, and therefore their costs over the course of a month will shift a lot more quickly than someone who has to essentially wait for the end of their fixed term mortgage for them to then renew at the higher price. So it means that the housing market is likely to be a lot more flexible and sensitive to movements in terms of interest rates. It does provide them the basis to potentially want to cut interest rates sooner, but the Australian housing market still remains relatively strong. So we're not necessarily in a position where they're having their hand forced at the moment. In terms of imports, exports, we have seen a significant drop off over the course of 22-23, picking up a little bit since, but certainly in terms of exports, that has been hit hard. Most notably, I would say, because of the relationship they have with China and the weakness that is ongoing within the Chinese region. So certainly this is a cause for concern, and this will be a reason for them to think, you know, soon enough, if this doesn't pick up, they might have to step in to try and essentially enable the economy, boost the economy to get growth kick-started. But we have notably seen the likes of exports start to turn higher, which would point towards the possibility that they might hold off essentially. In terms of retail sales, you can see tracking lower on a month-on-month, sort of gradually moving lower and lower. So 1.28 in terms of that annual figure. So not necessarily a particularly convincing trajectory in terms of domestic spending, but you've got to say that ultimately the job of the RBA for the time being is to essentially guide the economy into a soft landing. A soft landing doesn't mean they want to enact a recession, but they need to calm spending habits to quell demand and to ease inflation. And so the fact that we've seen this retail sales number tracking lower arguably is the kind of thing that the RBA will want to see, because they want to drive inflation back down to target. Unemployment, we've just seen the Australian jobs report, and we saw unemployment coming in at 4%. This is, from a historical standard, very low. You can see the levels pre-pandemic were up around about that 5% mark. So, you know, we have been moving higher since the lows of the pandemic. But arguably, from a historical perspective, we're quite used to seeing Australian unemployment at 5 to 6% in normal times. So the fact that it's at 4% means that they've arguably got plenty of space to run into before the RBA's hand is forced. In terms of GDP, we can see the annual GDP 1.11%. The quarterly figure sort of tracking relatively low at the moment. The sort of growth rate, you're looking at 0.5% for the near term. So, you know, what we're seeing is, again, this sort of soft landing approach, essentially, where we're seeing, you know, not a huge amount of growth, but enough growth to say, you know, they're in positive territory. Retail sales tracking lower, growth tracking lower, but they're not in a position where their hand is being forced. So arguably, this is a good position for the RBA. In terms of market expectations for the interest rates over the course of this year, there has been a shift over the course of the past month or so, where we had been pricing a higher likeliness of a rate hike this year, now relatively minimal, quite frankly, versus a rate cut. Now, the expectation is that we won't see anything over the course of this year, but we have now started to see some movement in that back end December meeting. Now, 67% expectation that we won't see a hike over the course of this year, but there is a potential 30% chance that we do see a cut taking place in December. So that has been a notable shift. It's something that people will be keeping an eye out on around the pricing for this meeting, because arguably the RBA's outlook and meeting will essentially take place as a means of, yes, informing the markets if they see a reason to shift, but also giving the markets guidance in terms of where things should be from an expectation standpoint. So their job is not only to make those decisions when need be, their job is also to guide the markets. And so if they're starting to think that they could cut rates this year, then they'll start to feed that into the narrative somewhat. In terms of inflation, we can see here that the inflation rate has been moving lower. On a monthly basis, we have seen some concerns over this inflation number, and that's why we did see a significant sort of pick up in expectations for another rate hike at the last meeting. But whilst we've seen this decline in both core and headline inflation, the Australian 10-year hasn't really rolled over to the same extent. And that highlights a degree of skepticism within markets around the ability of the RBA to drive that figure back down to target. So we're still some way off target. And the upwards trajectory that we've seen the Australian 10-year yield does highlight that skepticism over the ability to get it back down to target. Like I said, that past figure in terms of inflation from Australia was a concerning one, 0.96 on the quarterly basis, bearing in mind the likes of Australia releases their CPI every quarter rather than every month. So the metrics and the breakdown sort of shift somewhat. But as you can see at the bottom, the 3-month annualized figure. So essentially, where should we stand by the time the next figure comes in? Well, that's at 3.71. So an expectation that we could see a rise in terms of inflation. There looks to be a difficulty in getting away from this sort of mid threes area. It's exactly the same kind of thing that we're seeing in terms of the US. And so you can see why there's the basis for us to potentially expect a protracted period of hesitation in terms of interest rates from the RBA. You've got 1% in the last quarter. You've got 1.2 from Q3 of 2023. So we've got some pretty significant figures that need stripping out. And at the moment, according to the last quarterly metric, we're not necessarily moving in that right direction. Yields are going to be key within this whole thing. Essentially, if you're looking for the trajectory of one currency against another, a lot of the time you're essentially betting on the relative yields between the two. So here we do show exactly that. The likes of Australia, 4.2%. It's notable that, of course, where I was highlighting where interest rates are from the central banks, we saw the Eurozone at the bottom, the likes of the Canadians relatively low as well. But what we've seen here in terms of the Australians is that they're relatively high here, despite the fact that Australian interest rates are below many of these other interest rates. And so the expectation here hasn't necessarily shifted to the degree that they would have potentially liked. And it's this relative valuation in terms of yields that will essentially drive price going forward. Here is the euro against the Australian dollar. And so what we have started to see is some weakness coming into play here for euro Aussie. But what we're looking in terms of yields is that we've actually seen the Eurozone European 10-year rising relative to the Australian 10-year. So what we would need is a relatively hawkish stance from the RBA, and for them to essentially rule out a rate cut this year. Things like that could potentially drive up the 10-year in Australia, drive the relationship between the two lower here, and point towards a potential top here for the euro Aussie. In terms of Aussie dollar, a similar kind of thing. You can see that pretty close correlation between the likes of the Aussie dollar against the US dollar versus the Australian 10-year and the US 10-year. Of course, we have just heard from the FOMC, and what we're seeing at the moment is that Australian yields are gaining some ground, but you can see that we are essentially seeing two central banks that are struggling with inflation. Like I said, both of them in a position where we are seeing the mid threes in terms of inflation and likely to stay there for much of this year. So you can see why, and certainly if you look at the comparative 10 years yields, we've essentially been range bound over the course of this year. Similar in terms of that currency pairs, you're essentially waiting for that sort of divergence to happen. You could say, well, that divergence was happening because the likes of the US Federal Reserve were expected to cut interest rates 2 to 3 times. But as we've seen over the course of this year, that keeps just getting pushed back and back and back. And I think there's a good chance we don't see an interest rate cut at all this year, quite frankly. So, you know, maybe they're in the same position as the Australians. So certainly at the moment, in terms of the inflation trajectory, we're not necessarily in a position where markets are going to feel super confident that we're about to see an interest rate cut from the Federal Reserve. And we've also got here just the Australian 10-year yield overlaid with the Australia 200, the ASX 200. And so what we're seeing here at the moment is, and bear in mind, I've inverted yields. So what we're looking for here is a decline in terms of the Australian 10-year. That would essentially come from things such as feeling more optimistic that we're going to see a cut this year. Things like that would likely drive down the Australian 10-year yield and would drive up the likes of the ASX 200. So as one might expect, any dovish tones coming out from this meeting might instigate a sort of rebound here in play for the likes of the ASX 200, whereas a more hawkish tone would likely come at the detriment of stocks within the region. Now, in terms of the index itself, I just wanted to show you it on greater detail here. So from a wider perspective, we can see here that we've sort of seen protracted periods of uptrend, but then we saw this consolidation taking shape over much of 2021, pretty much the entirety of 2022 and 2023. The breakout through that resistance level came at the inception of this new year, and we've been largely sort of consolidating since then. We sort of saw that pullback. We tried to regain ground, but now we're sort of struggling once again. So, are we just going to remain within another range, or are we essentially looking to build energy to further ourselves after that bullish breakout that we saw at the turn of the year? Well, on the top end, you can see what we're seeing, sort of lower highs in play here, up here. So it's not perfect, but there you go. We've got 3 touches on the top end. So we've got the creation of lower highs with deep retracements. And on the bottom end, we're also seeing higher lows, right? So a symmetrical triangle, essentially, which points towards the near-term downside as being a potential precursor to the bulls coming back into play. But we are in the middle of that at the moment. The question mark, of course, is, what's the outlook going to be from the RBA? Like I've highlighted, in many perspectives, they're in a sort of very good position in terms of that sort of soft landing, not too soft. They don't necessarily have inflation hitting target anytime soon. And therefore, I think it's quite likely we're going to see them holding off over the course of this year as expected. It's just whether we see markets taking that as a negative because of the gradual pricing in that we've seen around that December rate cut. Nonetheless, you can see here this pullback coming into play. I think there's a good chance that we're going to see a sort of retracement here. You can see here in terms of the sort of fib level 76.4 here is 7660. So near term could see some weakness, as you can see here with this sort of head and shoulders formation. But that downside is likely to be short-term in nature unless we see a breakdown through this 75.94. That would be required to point towards a wider rolling over for this index. Until then, we've still got this symmetrical triangle formation in play, and near-term downside could bring us into an interesting area with that 76.4 fib and that incomplete ascending trend line. Then, like I said, when it comes to the Aussie dollar, we've kind of got range bound movement, but with Euro Aussie, we've got the potential for this market to roll over if we see continued rate cuts from the likes of the ECB, and we see the likes of the RBA hold off over the course of this year. You've got the possibility of this market rolling over, and we can see exactly how that's been taking shape very crudely. You can see on the, if I'm to sort of draw the bottom end of this, and then you're to say, where are we moving now? You can see that trajectory is now essentially sideways or gradually moving backwards. Some could say, well, this is just a pause before we move higher once again. I see it more as a potential topping pattern. We've completely taken all of the a bullish trajectory out of this pair, and we're now essentially flatlining. If we see a breakdown below 1613, essentially, that gives us this very wonky head and shoulders formation. But ultimately, the story is the same. The creation of higher highs and higher lows turns into lower highs and lower lows, and that would come with a breakthrough 1.613. Over the near term, we can see exactly how that's playing out. Sort of near term, deep retracements turning into more shallow retracements. The breakdown that we're seeing at the moment, given the fact that we've broken through support of 162, we could see a near term rebound, but certainly, I think the near-term trajectory points towards the potential for downside. But if we do break this 1.6129 support level, that could set us on our way for another move towards the downside here for the euro against the Australian dollar. And given the fact that we've seen this very strong move towards the upside over the course of 2022, moving into the first half of 2023, you could say, well, from a historical perspective, we're relatively elevated here. We've seen this protracted move higher. Now it's time to start taking back some of those gains that we have been seeing. And certainly a breakthrough that swing low of 1.6129 would be key in instigating such a move. But certainly it looks like a interesting meeting ahead for the RBA. There's arguments that they are crafting a nice soft landing, but inflation remains a problem, particularly services inflation, And that means that there's a good chance that they might hold off for longer than most. And from an FX perspective, that could bring the possibility of further upside for the likes of the Australian dollar.